right. Well, welcome everyone to everything investors need to know about the new tax laws in 2022. I know a lot of you were very, very interested in joining us and hearing from Thomas Castelli, sorry, an expert. And what I really love about Thomas and Brandon and everyone at Hall CPA is that they explain things in a very easily digestible manner, because a lot of times when you're talking to CPAs, it's very hard to understand, and they make it easier to understand. So I'm really excited to have him join us tonight, and I'll do a quick intro, and Thomas will do a quick intro, then we'll go through it, and then happy to answer any of your questions at the end of it. So for those that don't know me, I'm Gary Lipsky, president of Break of Day Capital. We typically buy in Phoenix and Tucson. We have over $100 million in assets under management. We have just about $100 million in escrow right now on properties. We do have a live deal as well. So if people are interested, we could talk more about that later. I wrote the best-selling book, Best in Class. It's everything from A to Z on asset management. Definitely recommend checking it out if you haven't. And I have a podcast, the Real Estate Asset Management Podcast, and started a nonprofit in about 2005. We worked with underserved youth in LA, and really proud of what we've done there. And for Break of Day, we're always about building wealth with investors through aligned goals, transparency, and first-class communication. And I'm going to be speaking at MFIN Con in Charlotte, June 23rd to the 25th. So if you're going to be out there, definitely let's connect, say hello. They have a great speaker lineup, Shaq and Jocko Willink, and Barbara Corcoran, and a lot of other friends that I have that are in the real estate space. Should be a really good conference. This is our portfolio and track record. Most of these deals are in Tucson. We're experts in that market, as well as Phoenix, and just focusing on a couple markets really gives us great broker relationships, thousands of data points. Instead of syndicators that are chasing deals all over the country, we're very focused, and that gives us an edge. We've had some great sales last year, 2x and 1.7x in under 2 years. We've got one in escrow right now to sell, and assuming that goes through, that'll be well above our pro forma for our investors. And another one, we put it on the market too. That'll be another home run for investors. And the live deal we have going on, Mission Antigua, it's a $59 million acquisition price, 248 units, B class in Tucson. Beautiful property. It's that lower middle picture. Here's some more pictures of it. If you want to learn more about it, Jacqueline will put it in the chat, where you can go to our portal and check out the investment summary and more information. It does have 80% bonus depreciation, which is fantastic for those that can take advantage of it. Definitely want to take advantage of it this year, as it'll start getting reduced year after year going forward. All right, and without further ado, I am going to stop my share and let Thomas take over.
All right. Okay.
Let me hit that. All panelists. All right. All right. You should be able to share.
Okay. So here we are. All right. Let me just see. Slideshow. All right. So what we're going to be covering today is multifamily taxes for passive investors, also known as limited partners. Before I dive right in, quick introduction to me. My name is Thomas Castelli. I'm a partner at Hall CPA, PLLC. We're an accounting firm that exclusively services real estate investors. We have clients who have single family rentals, who have limited partnership investments, and syndicators like Gary, who we work with. And basically, what I've done over the last 5 years is I've advised clients on how to minimize their taxes. So I've seen a lot of things And we're going to cover some of that stuff in here today. All right. So before we dive right in, I do want to give a quick disclaimer. This presentation is going to be for informational purposes only and should not be construed as tax, legal, financial, or other advice. Please consult your own tax advisors to see how what we discussed today may impact you. At the end of the day, it's hard to cover everybody's individual situation on a general presentation like this. So really what I'm going to do is give you guys the ammunition to go have conversations with your own tax advisors on how to reduce your taxes. So what we'll be covering is tax implications of limited partnership investments, an overview of the partnership basis rules. That's important to know as you are going to be a partner, as a limited partner, of course. We're going to go through what to expect from different types of LP investments. We're going to go through where LPs can find their income, losses, distributions, and capital gains, where they're reported on a Form K-1. We're also going to go through tax strategies on how to minimize taxes as a limited partner. And at the end, we'll, of course, have a Q&A. So before I just dive into the presentation, I know I've said that a few times, but before I dive in here, I do want to give a quick overview of the passive activity rules and why real estate investing is just so powerful for investors to begin with. All right. So way back in 1986, there was a tax legislation that was passed called the Tax Reform Act of 1986. And what that did is that made all rental activities passive by default. And what that meant was you could not take losses from your passive activities and use them to offset your active income. Because what was happening way back then, before this was passed, you had a lot of high income earners such as doctors, sales reps, lawyers, and so on and so forth. They were making a ton of money and going and buying real estate investments, whether they be direct, like a single family rental property, or investing in a syndicate or fund, and then using these losses to offset their W-2 or active business income and save a tremendous amount of taxes. And that was very controversial at the time. And there was a lot of talk about it. So eventually what happened was the Tax Reform Act of 1986 passed the passive activity loss limitations, also known as Section 469, and limited people's ability to do this. I mean, to take losses against their active income. So now what we have is the ability to invest in real estate and use the losses to offset your real estate income and pretty much increase your income without increasing your effective tax rate. And to just give a quick example, if you have a job or you have an active business that you're running, you're paying tax. That's tax as ordinary income from anywhere from 0 to 37%. I would imagine if you're investing in limited partnership interests, you're probably somewhere in the 24 to 37% tax bracket, which means you're paying 24% to 37% per dollar of income to the government, to the federal government. And if you live in a state that has state tax, you're paying state tax. Well, and the problem with all this is that you're paying tax at these high rates, and your income is very, very difficult to shelter from tax, this type of income, W-2 or active business income. However, when it comes to income from real estate, you can easily shelter that using what we're going to discuss today. And what I want to start off with here, having said all this, is a quick overview of tax implications for LP investments. And it's specifically going to be on how the taxes on those investments, how the income on those investments are taxed. All right. So rental income is also taxed at your ordinary income rates, again, up to 37%. They can be subject to state tax. They can also be subject to 3.8% net investment income tax, also known as NIT, if you have income above 200K if you're single, or 250K if you are married. So if you're at the top tax rate, you can be getting taxed up to 40.8% at the federal level alone. But the good news is rental losses are considered passive losses and can offset your passive income, right? So basically rental income is considered quote unquote passive income, and you can use passive losses from other rental activities to offset your passive income, mitigating it. And again, this is something you can't do with your active W-2 or active business income. All right. So cost segregation and 100% bonus depreciation often causes what's known as a non-cash loss that can be used to shelter your rental income and other passive income from tax. And then any unused loss is suspended and carried forward into future years and can be used to offset your passive income in future years. And then when the rental property is sold, or the underlying rental property in the case of a limited partnership investment is sold, any suspended passive losses that you accrued over the years can be used to offset the gain on sale of that property, any other passive income you have. So any other rental income, or maybe you have limited partnership interests in other businesses, these losses can be used to offset that as well. And then if there's anything remaining after all of that, after you offset your gain on sale, after you offset any other passive income you have, losses can be used to offset your W-2 or active business income. All right. And the best way I can explain this is with an example, right? Let's say that you have $10,000 in rental income that you generate through the year, or your share of a limited partnership interest generates $10,000 of rental income, right? Well, you can have $6,000 of hard expenses. And what I mean by this is expenses like property management fees, repairs and maintenance, property taxes, utilities, so on and so forth. These are expenses that you're actually taking out of the bank account and you're sending them to the vendor and you don't get it back, right? But now let's say you have a $5,000 depreciation expense. Well, depreciation is a non-cash expense. So that means it doesn't take money out of your pocket, but for the purposes of taxes, it does decrease your taxable income. So again, if you have $10,000 of rental income, you have $6,000 of hard expenses, but now you have $4,000 left over, right? $4,000 of cash. But now you add this non-cash depreciation expense of $5,000 in, and you now have a $1,000 loss. So what does this mean? Well, the first thing it means is that you're not paying any tax on your rental income, right? So that's fantastic. So you generated $4,000 of cash, but you're paying no money on taxes, right? You're paying no taxes. You have a tax loss of $1,000. Now the question becomes, what happens to this tax loss of $1,000? Well, okay, I don't have it on this slide. Well, the tax loss of $1,000 will be suspended and carried forward, and then it can be used in the manner I just described here to offset other passive income in the future, or the gain on sale of your rental property. Now, it's important to also note that capital gains are taxed at 0, 15, or 20%, and depreciation recapture is also generally taxed at 25%. So these are the taxes you're going to pay on the sale of the asset. Hopefully there is a gain. In many cases, there will be, especially in this market, you're going to have a significant gain. And they're also going to be subject to the 3.8% net investment income tax, also known as NIT, that I mentioned before. It can also be subject to state tax, depending on what state you live in. And the good news is, again, that you can use these current or suspended passive losses that you have, that you're generating from real estate, these paper losses, to offset and mitigate the capital gain on the sale of this asset. So that's what makes investing in real estate so powerful. You can increase your income without increasing your taxes. And there's one more thing I want to add in there before I move on, is that you can also offset your capital gains from the sale of real estate with capital losses from real estate, stocks, bonds, mutual funds, and other capital assets. Now, many people won't actually use the won't actually have many capital losses unless they're actually losing money. So it's not the most effective strategy. What most people are going to want to do is use current and suspended passive losses to offset the gains. And I'll get more into that in a little bit. Before I do, I just want to talk a little bit about partnership basics. As a partner in an entity, you're just going to have a basic understanding of how this works, right? So generally speaking, when you make an investment into a fund or into a syndicate, it's going to increase your partnership basis. So let's just say you make a $50,000 investment, then your initial basis is going to be $50,000, right? Now your basis is going to be increased by the rental income that you have, right? So let's say that you have $5,000 in rental income. Your basis is now going to be $55,000. Now your basis will be decreased by the losses and distributions from that partnership. So if you have received $5,000 in rental losses instead, your basis is now going to be $45K, right? So you had $50K you put into the fund. Now your basis is $45K. And if you receive a distribution of $5K on top of that, well, now your basis is going to be $40K. So the reason why I'm just explaining this is just so you know, when you're looking at the bottom left hand of your K1, which we'll review K1 in a few minutes, you know what you're looking at and what's going to impact those numbers. Because at the end of the day, your basis is going to have, it can have some tax impacts, right? So just to kind of give a quick example, if you have, let's say you put $50,000 into a partnership and you get $55,000 in losses passed back for you. Well, only $50,000 of those losses are going to be eligible to be used in that year, because you cannot take losses in excess of your basis. So that's why it's important to understand basis. It's also important to understand basis because if you get a distribution in excess of your basis, then you can potentially be taxed on that distribution as a capital gain.
Hey, Thomas, I want to jump in. When you're talking about receiving a distribution of 5K and your boot basis is reduced, is that return of capital versus return on capital?
Right. So yeah, that's a good question. So if you, I mean, it's an interesting way to okay. So when you get a distribution, the distribution is not going to be taxed to the extent that you have basis, right? So I guess it would be considered a return on capital in that case, right? So what's going to happen is, say you have that basis of $50,000 and you get a distribution of $5,000, you're getting a return of your capital in that case, in that example. Even though the funds may have came from the cash flow generated by the property, you're technically getting a return of capital at that point, because it's reducing your basis.
So it really doesn't matter, because we do return on capital and we'll pay a pref, but that will still reduce your basis.
Right. It's going to reduce your basis. It will reduce your basis until your basis is zero, and then and then beyond that, you could get tax on capital gains on those distributions. But in my experience, that doesn't happen too often. But it's just important. It's just important to be aware of how this stuff works. I'm happy to answer any questions on this as we get to the end of the presentation. Now, just some things you want to keep an eye on. I know that Gary does a lot of value add, and value add is very popular. But just so you understand kind of what you can expect on from different types of limited partnership investments that you can make. If you invest in core or core plus, these are heavy on cash distributions. So you can generally expect a large loss in the first year from cost segregation and 100% bonus depreciation. And it's very possible that you have positive rental income in these investments at some point that will need to be sheltered by your passive losses from year one or from another property. You're also likely to see a moderate capital gain on sale when you're dealing with core and core plus investments. Now, when you're dealing with value add investments, these are typically a mix of distributions and long-term profits, right? So you could expect usually a large loss in year one from cost segregation, 100% bonus depreciation, just like core and core plus. And then there might be smaller distributions compared to core and core plus throughout the life of the deal, usually after the first year or two. And this is usually after the property is stabilized and it's beginning to be rented out again, and it's actually beginning to cash flow, right? So you could have positive rental income at some point, but these are typically sheltered by your suspended passive losses from future years. And you're likely to see a larger capital gain on sale because it's the value add. The entire point is to push the value of the property up, right? Then opportunistic and turnaround. These are usually pretty heavy deals where, they're either extremely, they're vacant and you need to come in and do an extreme overhaul, or you're maybe building from the ground up. You can expect losses in the first years and then a large capital gain typically at the end of the investment. So here's the keys to minimizing taxes as a limited partner, right? So if you have passive income from the partnership, from the rental income, it can be offset with the losses from your investments. And I've said that before in this presentation, but it's important to understand that. And these losses, the losses that you're generating, these losses that I'm talking about, these rental losses, or these losses from the depreciation rather, can be found on Form 8582 of your individual tax return, Form 1040. That sheet's known as the passive activity loss limitations. And you're going to want to keep an eye on that as a passive investor, because that's where you're going to track your passive losses. So when you have a capital gain from the sale of real estate, it can be mitigated by either A, investing in another syndicate or in another property in the same year, or using your suspended passive losses. So kind of just break this down a little further. Let's say that you know that a property or one of the syndicates that you're investing in is going to be liquidated. Let's just say in 2022, right? Well, if you know it's going to be liquidated, you know there's going to be a capital gain. So most likely, right? So you're going to go ahead, you're going to want to look at the form 8582 that you have on your individual tax return. You're going to want to take a look at your suspended passive losses. Do I have this 85? Here's the form 8582. So I'm going to break it down right here for you. All right. So on the form 8582, you're going to have your passive losses for the current year are pretty much going to be banked up right here. And then they're going to carry forward. If you can't use them all, they're going to carry forward on your form. So in this case, in this example, this is back from 2018, but pretty much the same form. You have $91,000 in passive losses. So you know that you can offset up to $91,000, give or take, of capital gains in the year of sale, right? But let's say you didn't have 90. Let's say the capital gain was more, or that you didn't have 91,000. It wasn't enough to carry to offset the capital gain. Well, in that case, what you're going to want to do is you're going to want to invest in another syndicate that's going to use a cost segregation study and 100% bonus depreciation in the year of sale to generate even more losses in that year, so that you can use those losses to offset your offset your that capital gain on sale, mitigate your taxes. So just kind of recap on that one more time. You know a sale is coming this year. You want to look at your form 8582. See, do you have any suspended passive losses from prior years? And if so, how much is it? Is it enough to offset the potential capital gain from the sale or not? If it's not, then you might want to go ahead and make another investment into another syndicate, or maybe buy a property directly if that's a strategy you also employ, to go ahead and generate enough losses to offset the capital gain on sale. So that's the biggest thing limited partners can do from a tax perspective to mitigate tax is monitor this form. That's why I'm harping on it here, form 8582, and make sure that in the year of sale that you have enough suspended passive losses from prior years or the current year from investments you made in the current year to offset the capital gain on sale. Otherwise, you want to consider making another investment. And that, again, that's the biggest thing you can do as a limited partner is do that. It's a timing game, and you want to make sure that you're minimizing your taxes so that you can take as much money as possible now, today, and reinvest it, because the time value of money makes $1 today worth more than $1 tomorrow. All right. I think that's about it. So we could jump into some Q&A. If people have some questions, more than happy to answer as many questions as possible.
Yeah, we got one question here. Martin asked, what is the difference between a DST and a syndicate?
All right. So that's a great question. Okay. So a DST, a Delaware Statutory Trust, what a DST is a 1031 exchange tool. What I mean by that, so when you have a rental property, you have to, and you sell that rental property, you have to buy another rental property. You can't 1031 exchange into a partnership interest. You can't 1031 exchange for anything else but another property. So what ends up happening is people will own a piece of real estate. Maybe it's a single family residence. Maybe it's a commercial building, and they're going to want to sell it. And sometimes when you want to sell it, you don't want to be involved day to day anymore of operating a property, or you don't want to invest in another property directly. So what you can do is you can invest in a DST, because basically the IRS blessed the DST as a property for the purposes here. So you can invest in a DST, and the DST is effectively a syndicate that you can 1031 exchange into. So when you're investing in a DST, typically what a DST is going to own large commercial properties. They're going to own like a Walgreens, or they're like a Walgreens on triple net lease. They're going to own like a Best Buy, these types of big box retailers. That's what they're going to be investing in. And you can take your property that you sell and invest it into the DST. So just to kind of answer the question directly, the difference is between a DST and a syndicate is a syndicate's typically a partnership that's raising money and buying a property and then doing a value add or doing some type of other makeover to get the property increase its value and get it cash flowing. Whereas the DST is typically buying a stabilized property, DST is a trust and it's buying a stabilized property, and because it's a trust that's designated as a 1031 exchange acceptable asset by the IRS, you can 1031 exchange into the DST, but you're unable to 1031 exchange, generally speaking, into a syndicate.
Another question I get is people want to do a 1031 and it, for small amounts, it doesn't really make sense. Can they, liquidate and take the money and put it into a deal where we have like 100% bonus depreciation and wipe out their gains and their taxes that way? Is that, if it was 1031, would it still consider passive losses, or how does that work?
Yep. So just kind of recap, you're saying you basically take a deal sold, say in 2022, for example, and then they want to take that money, reinvest into another syndicate, use the losses to offset the gain. Yeah.
Instead of doing a 1030, they have like 300,000 to do, and they want to do a 1031, and it doesn't really make sense. Our minimums, and most people that are syndicating have a minimum of, let's say, 500,000 or 700,000, and
right.
Those smaller amounts, it just doesn't make sense. But can they wipe out their tax gains that way? It's active versus passive. Want to get your opinions.
Yeah, absolutely. So if you sell a property, whether you own it directly or it's through a syndicate, you can invest that money into a syndicate like the ones Gary has with the bonus depreciation, and you can use the losses from that syndicate. Those losses can get passed through to you on the K1, and they're going to be used to offset the gain on the sale of that other property. And you can do that, and you could avoid using a 1031 exchange. Some people even call this strategy a 1031 exchange light, because you're investing in another property, but you're not actually doing a 1031 exchange, but you're going to get these losses passed back through to you, and they can be used to offset that capital gain from the sale of that original property.
Nice. All right, we got another question here. Would a 1031 exchange only apply to GPs? No.
Right. So here's how it works, right? So when you do a 1031 exchange, you have to exchange property for property, and the same owner of the property has to be the same owner of the next property. So if you're investing in a syndicate and you're a limited partner, the general partner can initiate the exchange. The general partner could say, you know what, we as a partnership are going to exchange 123 Main Street for 1234 Main Street, or whatever the property is called. And all the limited partners can either come along for the ride, or they'll typically get bought out or resold to different investors, whatever the case is. But the point is here is, because you're a limited partner, your interest in the partnership, you have a partnership interest. You don't have real property directly. The partnership owns the real property. So as an LP, the only way you can do a 1031 exchange is if the GP, if the general partnership group does it, and the whole partnership does it. So if you're a limited partner, what you're going to want to do is the way you can do a kind of a 1031 exchange would be to go ahead and take the proceeds from the sale of that property that was sold in that year and go ahead and invest it in another syndicate or another property that's going to generate losses. That's going to be your best tax mitigation strategy, because again, you can't use a 1031 exchange directly as a limited partner.
Got another question. What's the difference between a real estate CPA and a tax strategist / attorney? Which one is more beneficial for investors in the long run?
Right. Okay. So a real estate CPA can also be a tax strategist. And so can a tax attorney, can also be a tax strategist as well. So a tax strategist is more or less something you do. It's someone who helps you plan to mitigate taxes and reduce your taxes, and looks at like the playing field of the tax law and sees what you can do within it. A CPA, a real estate CPA, is someone who focuses in real estate, and they can help you with tax planning, help you with tax preparation, help make sure the entity structures that you are using are appropriate from a tax perspective. Now, an attorney, a tax attorney specifically, they can also do all of the above I just mentioned, but they're more or less focused on the tax law and they're more focused on tax planning solely. Your tax attorney is typically not going to prepare your tax returns. They're not going to do your accounting for you. They're not really running numbers. They're doing like heavy, complex tax planning, whereas a real estate CPA can effectively do all of the above. But they can't write, I don't want to get too technical here. They can't write letters of determination. It's just, I forgot exactly what it was, but tax attorneys can write like letters of opinion saying that they're backing this tax position with their full authority of an attorney and all their understanding of law. Unfortunately, CPAs can't do that, but tax attorneys can. That's like the core difference, really.
And I would recommend all of you, like, find someone that is really a tax strategist, because most CPAs aren't, and you might need a financial advisor or someone like, Thomas says, it's going to take the time and figure out how to plan accordingly, because a normal CPA is just going to do your return and not typically have that strategy that is so important and so valuable.
Right. Most CPAs out there, like Gary just said, they just file tax returns all day long. One of the biggest complaints that we get from our clients who come work with us and why they're leaving their current CPA is because their CPAs either don't understand real estate. So they go to the CPA and ask questions, and the CPA is like, I have no idea, or you can't do that. Meanwhile, the client knows that they can, because they went and figured it out that they can do certain things, or that their CPA just doesn't give any tax advice and is just prepping the tax return. And the reality of the situation is, you're going to want to be meeting with your CPA several times a year, depending on your situation, probably somewhere between 2 to 3 times per year at least, to be discussing your tax situation and what you can be doing today, like what you can be doing now to mitigate your taxes. Because I'm a firm believer that the amount of tax, so your tax return at the end of the day, your Form 1040 and everything that goes into it, is just a report card of the income that you earned and the losses, the tax credits, et cetera, that occurred the year prior, right? And it's the actions you take during that year that are going to impact the numbers on your tax return. Because once the year closes, once 12/31, let's just use 2022, for example, closes, there's very limited things you're going to be able to do in 2023 to impact your taxes. Like, if like the most relevant example here, if you're going to have a capital gain from the sale of real estate this year in 2022, you have to make an investment this year, right? So you have to look at your taxes and say, do I have enough losses to offset this gain, or do I need to go and get more losses? And that's something that a CPA or a tax attorney, to be fair, can help you figure out. And then you're going to have to go make moves today. Because if you don't invest, or not today, but this year, if you don't invest in a syndicate before 12/31/2022, then you can't, if you invest in one in January 1st, 2023, you can't use those losses from that 2023 investment against your 2022 capital gain. So it's important that you have an idea of what your tax situation looks like and what options are available to you so you can mitigate your taxes.
Yeah, I see a lot of people at the end of the year rush into bad deals just to get that bonus depreciation. And so my advice to our audience is, find good deals now. You could roughly plan out your tax situation and invest now, and don't wait to the end of the year and get in something that is just you'll get some nice tax benefits, but the upside is very limited because you waited to the end of the year, where with a good strategist, you know where you're gonna land roughly way ahead in advance.
Right. And also, the biggest thing is finding good sponsors, like Break-of-Day Capital and sponsors who you can trust, so that when you have to make moves, so you could build the relationships with the sponsors, get to understand their business model, get to understand, what types of properties they offer and how their return and fee structure works and all those details. So that if you do go work with your tax attorney or a tax or CPA, and they say, hey, look, I need you to go what you need to do is go consider making an investment. You already know who the people you can know, like, and trust, right? Who are going to be able to and who can deliver the returns for you, so that you can comfortably and safely invest your money. And like Gary said, not wait until the last minute and end up getting into a bad deal, which definitely does happen.
All right, Vessi asks, if you are flipping a property purchased in a JV, selling within 12 months, do you get hit with the capital gains tax? And if so, can you minimize that tax burden if you do a 1031 exchange?
All right, so that's a lot right there. So,
yeah.
so typically, when you're buying a property with the intent to flip it, and so that means to buy it, fix it up, and then turn around and resell it, that's going to be considered, you're going to be considered a real estate dealer, right? I'm going to get into a little bit how you can maybe avoid that in a second, but you're generally speaking going to be considered a real estate dealer. And as a dealer, that house that you have is not considered a capital asset. So it's not going to be taxed as capital gains. Instead, it's considered inventory. Inventory, like a car, would be considered inventory to a car dealership, or a box of Cheerios to the grocery store. So when you sell that property, it's going to be taxed as ordinary income. And that means it's typically going to be taxed at your ordinary income rates, again, up to 37% plus state taxes, if you live in a state that has taxes. And it could also be subject to the self-employment tax, which is an additional 15.3% on top of the capital gains tax. So that's something you're just going to keep in mind. And because it's not considered real estate, it's not considered real property, it's considered inventory, you're unable to do a 1031 exchange. So basically, that's kind of how it works technically in a nutshell. Now, in some cases, and again, this is something you're going to want to speak to your specific advisor about to see if they're comfortable with it, and all the other facts and circumstances around your situation. If you're only doing one property every year, you might be able to get away with getting it classified as a capital asset, and getting capital gains exposure. But if you're doing this repeatedly, or it's very clear, there's like 7 different criteria that needs to be looked at. I don't have all of them off the top of my head, but what I'm trying to say is, if you're not going to hit any red flags, like, you might be able to do a capital asset, but generally speaking, it's going to be taxed as ordinary income. So
nice. And you asked 3 CPAs, and 3 CPAs might have a different answer. That's how I understand it, but I've heard, like, a general contractor that I've worked with before maybe has someone that's a little bit more aggressive, and I'm like, I don't think that's right, but
let me clear the air. I'm taking my CPA hat off for a second.
Yeah.
So I'm taking off my CPA. I'm just going to be frank for a second. So if you're only doing one every once in a while, there's a chance that you can just report it as a capital asset and get away with it. Nothing will happen, right? But if you are audited, it could come back to bite you. So what a lot of CPAs are comfortable with, they're comfortable if you're only doing one, letting it slide through. But if you're doing it frequently, or you're hitting major red flags, then most CPAs are going to stay home and pump the brakes, because the reality is that by the letter of the technical law, you are a dealer in many cases, and if you are audited. But because if you're only doing one, such a low volume, the audit chances are so low that many CPAs will be aggressive and let it slide. But technically, like I said, it technically is ordinary income. So
Michael asks if it's going to be if the recording, it is recorded, sorry, and it'll be on our YouTube channel, Break of Day Capital, probably tomorrow afternoon, so definitely check it out. Let's see, we got another question here, and keep the questions coming, we got a little bit more time. Sage, I'll ask, do you know any LP offering for investing in solar? I don't know personally, but I know they're out there, because we're putting solar on one of our properties, and I know, like, they're raising capital for that. So we're not putting any money up front, but we're going to get a savings of about 20,000 to 25,000 per year, because we did the solar. Now we could buy it outright, but we chose not to. I don't want to be the owner of solar. I'd rather get it for free and get a smaller savings. But I think that there are those opportunities out there. And Jacqueline posted the some information in the chat to schedule a call with me, and also our website, LinkedIn and YouTube channel. So definitely check that out. We got a few minutes left. Any other questions? And one thing I would definitely recommend, because the real estate CPAs and Thomas have a ton of free information. Thomas, maybe tell them where they can find out about all that.
Yeah, absolutely. So we have a podcast called the Tax Smart Real Estate Investors Podcast. It's pretty much wherever you can get a podcast, you're gonna be able to find it: iTunes, Spotify, Stitcher, SoundCloud, et cetera, et cetera. We have, I think, 200 episodes where we go very deep into real estate tax. It's a big primary focus. If you're into that type of thing, I'd suggest checking that out. We also have a free Facebook community. It's called the Tax Smart Investors Facebook group. You could find that by going to Facebook and typing in Tax Smart Investors. You'll find us. I think it's like 10 or 11,000 people in there at this point. And we do a lot of conversations in there. We answer a lot of questions. So if you do post questions, chances are myself or someone on our team or Brandon will answer it. And then that's the two primary ways. If you want to just check out us generally, you go to the realestatecpa.com. And then lastly, I have to plug this in there. I do have a Twitter. I started Twitter, and my Twitter handle is at Thomas Castelli _. So if you are interested in posts on real estate tax and that type of thing, I'm going to be doing that there too.
Yeah, and check out the free content, because it's not sometimes when there's free content, it's like 5 minutes of free content and then they're like pitching. It's not like that. So a lot of great information. I'm checking it out myself. So I highly recommend it. Gary Rice asks, what makes a deal have bonus depreciation 100% versus 70%?
Right. So that's a good question. So let me break it down. So right now, depreciation is I'll break down depreciation real quick. All right. So when you buy a property, you buy a residential property, whether it be a single family home or a 244 unit apartment building or whatever, it's depreciated typically over 27.5 years. So basically 127.5 over 30 years over that time. And what you can do is you can have a cost segregation study performed on the property, and it's going to break down the various components, because it's usually not just the building and the land. There's all these things that are inside. And property with a class life of 20 years or less is eligible for bonus depreciation. And that includes 5-year property. It's tangible personal property, things like carpets, appliances, certain type of cabinetry and fixtures and what have you. And then land improvements, which can be pools, decks, underground plumbing systems. These things can make up anywhere between 20 and 30%, in some cases more, of the property's purchase price. So, so let's just say you bought a property for $1 million, right? Well, you're going to get a cost segregation study performed, and you're going to have anywhere between 20 or 30% of that's going to be reclassified as 5 or 15-year property, which is eligible to be depreciated all in the year you acquire it. So right now, bonus depreciation is at 100% in 2022. So if you put your money in, if you do this, that 5 and 15-year property will be 100% bonus depreciated this year. And again, it's anywhere between 20 and 30% of the property's value typically. Now, I think what people, and then that 100% is going to start phasing out starting in 2023 to 80%, then down to 60 in 2024. But in this case, right, if you see 80% bonus depreciation, that typically means you can expect to get 80% of your capital back in the first year. And that's not unheard of at all. If you put $100,000 in, again, just using an easy number, it's not uncommon that you get $70,000 to $90,000 of that back, thanks to the power of bonus depreciation. So kind of two different ways to look at what that means, right? What like 80% bonus depreciation means. I hope that makes sense.
Cheryl asks, what is that Facebook group name again for for what you guys have?
Tax Smart Investor. So you can just go to facebook.com/group/tax smart investors, and you could do it there, or you could just search for Tax Smart Investors on Facebook, and you'll be able to find us quite easily.
And if you're looking for a deal with bonus depreciation, if you're an accredited investor, we do have a little bit of space left on Mission Antigua. It's a $59 million acquisition, 248 units, beautiful property, built in 1989. But I mean, if you look at it, it really looks like it's built in 2000. We have, if you invest 100,000, you'll get at least $80,000 in loss through bonus depreciation in 2022. So great opportunity for you if you're looking for some more passive losses. And if you're looking for my information, you can find it here. And we'll be back in about a month or so with another informative webinar. Thank you so much, Thomas, for coming on board and providing a ton of free information. And if people you guys out there looking for a great CPA and for some advice, definitely check them out. And we'll talk to you soon. Thank you so much.
Thanks for having me, Gary. Appreciate it.